Welcome to The Explainer. Today we're tackling a massive question. How on earth did a company, once celebrated as America's most innovative business, morph into its absolute most infamous corporate scandal? I mean, for 6 years straight, Fortune magazine literally named Enron America's most innovative company. It was a total titan. You had this soaring stock endlessly pulling in enthusiastic investors, and honestly, from the outside, it looked completely unstoppable. But, as we're going to see, that brilliant facade was hiding a much, much darker reality. So, let's dive right into how this giant actually collapsed.
To really understand this collapse, we've got to uncover Enron's central mystery. Because right behind those headline-grabbing profits and those ever-rising stock prices, there were these incredibly complicated financial structures. Structures specifically designed to keep outsiders totally in the dark. So what was Enron actually doing every day? How did they manage to fake such impressive financial results quarter after quarter? And maybe most importantly, why didn't Wall Street regulators or, savvy investors spot the danger sooner? Well, we're going to break down this entire story in plain English, starting right from the very beginning.
Section 1. The rise of Enron, from pipelines to trading.
So back in the 1980s, Enron started out as just your standard traditional natural gas pipeline company. Nothing too flashy, right? But then the 1990s hit, bringing massive deregulation to the energy markets, and Enron saw an unprecedented opening. They completely evolved. They went from simply moving gas through pipes to becoming this massive energy trading business. Fast forward to the late 90s, and they've completely rebranded themselves as a highly sophisticated, tech-driven giant. They cultivated this aura of pure innovation, and let me tell you, Wall Street was absolutely hooked.
Section 2. Skilling and stock pressure, the push for performance.
Enter Jeff Skilling. Under his vision, Enron made a massive pivot toward energy trading. They started treating energy contracts not just as physical deliveries of gas, but as tradable financial products. Now, this fueled some truly explosive expansion, but it also birthed a relentless, kind of toxic corporate culture. The absolute #1 obsession, the rising stock price. Because executive compensation was so heavily tied to these stock metrics, the internal pressure to continually produce aggressively strong financial results, well, it just became absolute.
And, this really highlights a crucial lesson for any of us investing today. Rapidly rising expectations can create incredibly dangerous incentives. Instead of building a solid foundation of genuine, lasting economic value, Enron's corporate culture shifted entirely toward creating a theatrical illusion. They weren't actually building a sustainable business anymore. They were just propping up the appearance of one, doing whatever it took to keep that stock price continually climbing up into the stratosphere.
Section 3. Mark-to-market accounting explained. Estimating the future.
Okay, let's talk about mark-to-market accounting. This is a method where a company recognizes the estimated future value of long-term contracts, but they recognize it today. Now, it's really vital to understand that this practice itself is not inherently illegal. Lots of massive companies use it. But the danger, and frankly, this became the core weapon at Enron, lies entirely in how wildly optimistic those estimates can get when executives are just absolutely desperate to hit their quarterly targets.
Here's exactly how that danger plays out. Think back to the year 2000. Enron famously partnered with Blockbuster Video in a deal to deliver movies on demand over the internet. Under normal, traditional accounting, a company would just report actual profits year by year as users actually paid to rent the movies. Simple, right? But under Enron's super aggressive mark-to-market strategy, they immediately estimated how much profit that partnership might make over the next 20 years, and they booked over $110 million in profit that very quarter. The crazy part is, the deal completely fell apart just a few months later. Yet Enron kept those massive, entirely imaginary profits right there on their books. They were claiming profits based entirely on wildly optimistic guesses rather than actual hard cash in the bank.
Section 4. Hiding debt with SPEs, the illusion of success.
Now, claiming future profits today? That was only half the magic trick. The other half was masterminded by the Chief Financial Officer, Andrew Fastow, using something called Special Purpose Entities, or SPEs. Just imagine hosting a party in a really messy house. Instead of actually cleaning up, you just sweep all the clutter into a spare closet and lock the door. So to your guests, the house looks spotless. Fastow used these SPEs as separate financial compartments to lock away Enron's toxic debt. He was executing transactions so incredibly convoluted that outsiders couldn't even begin to see the mess hidden in that closet.
So Enron used these entities to just move massive liabilities completely off their official books, severely obscuring their true financial health. And bizarrely enough, Fastow even named several of these complex shell companies after Star Wars characters, like Jedi and Chuko. I mean, you can't make this up, but it gets worse. Many of these partnerships were directly controlled by Enron executives, specifically Fastow himself, who raked in millions of dollars in personal management fees. Obviously, this raised massive conflict of interest red flags. It created this impenetrable financial black box, making it completely impossible for anyone on the outside to see the crushing debt Enron was actually accumulating.
Looking at all these aggressive maneuvers, from the mark-to-market fantasies to the debt-hiding shell companies, we really arrive at the ultimate question here. Was Enron actually a profitable innovator, or were they literally just creating the appearance of value? Because day by day, the gap between their formally reported financial statements and the actual boots-on-the-ground economic reality of their business was just growing wider and wider.
Section 5. Cracks in the foundation. The warning signs appear.
You know, major corporate failures almost never happen overnight. They're the ultimate result of compounding risks and severe oversight failures. And for Enron, the warning signs were flashing bright red. Their financial statements had become so absurdly complex that they were generating way more questions than answers. The company was trapped. They were heavily dependent on continually showing strong financial performance, basically just to keep this massive house of cards standing. Soon, some astute analysts and journalists, like Bethany McLean over at Fortune magazine, started publicly asking really hard questions about how Enron actually made its money. Meanwhile, quietly, right behind the scenes, Enron executives began frantically dumping their own stock.
Now, at this point, the general public was still entirely in the dark. Enron's stock was still soaring, their executives were being lauded as absolute business celebrities, and their reputation felt pretty bulletproof. But underneath that shiny marble exterior, the foundation was severely fracturing. The relentless pressure to perform, those highly aggressive accounting tactics we talked about, and the hidden mountains of debt, they were finally catching up to them.
Which brings us to a rather chilling reality. What actually happens when investors suddenly realize that the billions of dollars they trusted were nothing more than an accounting illusion? Well, in part 2 of this explainer, we are going to explore the brave whistleblower who brought the whole thing down, the sudden and catastrophic collapse of investor confidence, the massive criminal trials, and of course, the resulting regulations that completely changed corporate America forever. But until then, I'll leave you to ponder this. How closely are you really looking at the foundations of the companies you trust? Thanks so much for joining me, and I'll catch you in part 2.
Welcome back to The Explainer. If you caught the first part of this story, you know we left Enron balancing right on a razor's edge. Let's do a super quick recap. We saw Enron's almost unbelievable rise from a boring, traditional pipeline company into an absolute energy trading behemoth. But, with that massive hypergrowth came a crushing amount of pressure. They had to keep up appearances. So they turned to some ridiculously complex financial structures, those special purpose entities, or SPEs, just to hide their toxic debt. Add in that aggressive mark-to-market accounting where they were essentially booking hypothetical future profits as cash today. Man, it was a literal house of cards. The warning signs were flashing bright red everywhere, setting the stage for one of the most dramatic falls in corporate history. And eventually, the sheer weight of all those hidden debts and totally unrealistic projections just hit a breaking point. You simply can't hide reality forever, even in the most famously complicated financial statements. The brilliant illusion was cracking. And pretty soon, the entire market, from the big Wall Street analysts down to everyday investors, started asking themselves one incredibly crucial question. What was actually happening inside Enron? Well, let's look at Sherron Watkins to figure that out. She was a VP at Enron, and she became an absolute legend in this saga because she was the one who actually raised the alarm internally. She fired off a direct memo to the CEO, basically warning that the whole company was about to implode in a massive accounting scandal. But look, this isn't just a story about one brave whistleblower. It's a huge lesson in corporate culture. Enron had bred this totally ruthless environment that severely punished anyone bringing bad news. When your culture actively discourages tough questions, those internal warnings just get buried deep. It proves exactly why rigorous, independent oversight is absolutely critical. So Enron was hurtling toward a massive psychological and financial wall, a confidence crisis. Think about it. In the business world, trust is quite literally currency. And a confidence crisis, that's what happens when that trust just completely evaporates. A regular business can survive a bad quarter or a failed product launch, but when you're highly leveraged and financially tangled up like Enron, you survive solely on the faith of your investors, lenders, and trading partners. The second people started questioning Enron's math and the stock started slipping, that faith vanished. And once trust is gone, the end doesn't just approach, it hits you at terrifying speed. Making matters infinitely worse were some incredibly shocking moves right in the boardroom. In August 2001, leadership confidence just shattered. CEO Jeff Skilling unexpectedly resigned. He cited personal reasons after barely 6 months on the job. Let me tell you, in the financial markets, leadership stability is everything. When the chief architect of your entire business model suddenly grabs a parachute right when the questions are getting loud, it is a massive glowing red flag. His abrupt exit sent panic skyrocketing through the ranks of investors and employees. Former CEO Kenneth Lay stepped back in to try and calm the storm, but the damage was already done. The sheer speed of the collapse from that point was staggering. October 2001 hits, and Enron announces a massive financial restatement. Basically, they were admitting that years of their previous financial reports were completely wrong, revealing hundreds of millions of dollars in losses. That was the fatal domino. By November, investor confidence was totally gone. The stock was in absolute free fall, and they lost access to the vital credit they needed to run their day-to-day trading business. No cash, no credit, no trust. They hit a brick wall. And on December 2nd, 2001, Enron filed for Chapter 11 bankruptcy. At the time, it was the largest corporate bankruptcy in U.S. history. Now, it's so easy to talk about this stuff just using charts and numbers, but we cannot ignore the human cost here. The emotional weight of this collapse was immense. This wasn't just a corporate failure, it was a human tragedy. Over 1,000 employees lost their jobs literally overnight. And it gets worse. Enron had heavily pushed its own people to invest their retirement funds into company stock, so thousands of regular folks saw their entire life savings wiped out in days. Investors lost billions, creditors were left empty-handed, and countless business partners took a massive hit. The collateral damage was just absolutely devastating. So you're probably wondering, how on earth was this allowed to happen? How did these fake numbers get rubber-stamped for so long? Well, that brings us to the independent auditor. By definition, an auditor is supposed to be your external gatekeeper. They're the professionals hired to check a company's books and promise the public that the financial statements are accurate and trustworthy. Our whole financial system literally relies on this check and balance, which leads us straight to the unbelievable tragedy of Arthur Andersen. At the time, Arthur Andersen was an 89-year-old institution. They were one of the big 5 accounting firms in the entire world, and they were Enron's auditor. As Enron collapsed, everyone naturally turned to Andersen and asked, "How did you miss this?" Well, as government investigators swooped in, a shocking truth came out. Staff at Arthur Andersen had engaged in widespread document destruction. They were literally shredding tons of paper and deleting tens of thousands of emails related to Enron. This triggered a massive criminal prosecution of the firm itself for obstruction of justice. The reputational damage was instantly fatal, leading to the complete collapse of this 89-year-old accounting giant, costing tens of thousands of Andersen employees their jobs globally, and sparking a worldwide reckoning on corporate governance. With the company completely in ruins, the public was absolutely demanding accountability, and the Justice Department stepped up with sweeping indictments. Chief Financial Officer Andrew Fastow, the guy who masterminded those complex SPEs, pleaded guilty to wire fraud and securities fraud, and he cooperated with prosecutors. Jeff Skilling and Kenneth Lay both faced intense, highly publicized trials, and both were convicted on multiple counts of fraud and conspiracy. Lay actually passed away before his sentencing, which legally vacated his conviction, while Skilling went on to serve a lengthy prison sentence, although it was reduced later on. The individual legal outcomes varied a bit, but the ultimate message was loud and clear. Executives were going to be held accountable. The shockwaves from Enron and a few other massive frauds that happened right around the same time, like WorldCom, forced Congress to take drastic action. They had to stop this from happening again. And the result was the Sarbanes-Oxley Act of 2002, commonly known as SOX. It completely shook up corporate America. It demanded way stronger financial reporting, forced CEOs and CFOs to personally sign off on the accuracy of their numbers, required super strict internal controls, and drew a massive hard line to make sure auditors stayed truly independent. It was a huge regulatory shift, but as history constantly reminds us, laws alone can't entirely cure corporate misconduct or human greed. Okay, let's transition into what I like to call the survival guide for modern investors. Because the Enron disaster wasn't just some crazy historical event, it is literally a textbook on what not to do. We've taken all this massive complexity and boiled it down to 5 absolutely critical lessons, drawn straight from the ashes of Enron. These are principles you need to keep in your back pocket to protect yourself out there in the market. Let's break down the first two. Number 1, complexity hides risk. If you are looking at a business and you genuinely can't figure out how they make their cash, you have to dig deeper. Enron's financials were designed to be an unsolvable puzzle. Number 2, incentives matter tremendously. Enron heavily rewarded its executives for closing deals and pumping up the stock price, not for actually generating real cash flow. Listen, aggressive compensation targets will heavily dictate how executives behave. If you pay people purely to make the numbers look pretty on paper, regardless of reality, that is exactly what they're going to do.
Moving on to lessons 3 and 4, which dive into the internal mechanics of a business. Transparency matters. A healthy company will always explain its big risks clearly to investors. They don't just bury them in hundreds of pages of dense legal footnotes. And perhaps even more critically, corporate culture matters. A company absolutely has to create an environment where employees feel safe raising a red flag without getting fired or completely isolated. When Sherron Watkins spoke up, she was a total anomaly in a culture that demanded blind loyalty. If bad news is not allowed to travel up the chain of command, that company is flying totally blind.
And our fifth and final lesson might just be the most common trap for everyday investors. A rising stock price is not the same thing as a healthy underlying business. Market hype, excitement, and momentum, those can easily exist right alongside catastrophic structural problems. Enron was the absolute darling of Wall Street. It was celebrated as this incredibly innovative company, and the stock was soaring, all while the actual underlying business was bleeding cash and burying debt. A beautiful stock chart simply does not prove a business is actually healthy or built to last. When we zoom out and look at the whole picture, Enron wasn't just a company that had a little bad luck or even just a few bad apples. It was a complete systemic failure. It was the inevitable result of a catastrophic collision. It shows us exactly what goes wrong when insane financial complexity meets highly aggressive incentives, totally weak oversight, and a wildly toxic performance-at-any-cost culture. When those four things violently crash into each other, no company, no matter how big, no matter how praised, can survive the impact. I want to leave you with this one final, really powerful thought. The most dangerous business risk isn't always something you can easily spot in the headline numbers. Sometimes the absolute biggest warning sign is simply the fact that nobody can clearly explain how those numbers were actually created. Enron gives us one golden rule above all else. Don't just ask how much money a company claims it makes, ask exactly how they make it. Ask where the hard cash is coming from, what risks are lurking in the shadows, and whether their story holds up under real pressure. So next time you see a market darling rocketing to the moon, ask yourself, is this a solid foundation, or am I just looking at another house of cards? Thank you so much for joining me for this explainer. Make sure to subscribe to Wealth Decoded HQ for more deep dives and essential lessons from the world's biggest business failures. See you next time.